Happy Wednesday, everyone. Welcome to another edition of #AskRobco. It is going to be the final edition of 2020, and what a year it has been. I cannot believe that in January 2020, after the elections, hopefully the semi-end of Brexit or wherever that ends being today in the next few weeks, deal, no deal, we could never have expected the year that we have had. The upshoot and the positives of that year are #AskRobco, and we've had a wonderful 7-month ride with you in the industry. I can't remember the numbers, the X amount of thousands and thousands of registrations of people online, the 100 lenders and banks and global institutions that are joining the calls live or throughout the platforms, whether you're following on LinkedIn or YouTube or Instagram or all the other platforms. It has been fascinating. We have provided with the most up-to-date intel, data, market intelligence that we have, and provided that across the market, weekly updates across the whole spectrum: commercial, residential, HMOs, buy-to-lets, private banking, prime, super prime, high street, factory lending, boutique lending, regionals, building societies, challenger banks, you name it. We have been providing and talking to everyone. Our last show of the year, we have regular James been with us pretty much throughout. Welcome back, James.
Afternoon, everyone.
And we have a special guest with us to close out the year, Paul Lewis, Mansfield Building Society, and more famously or infamously known as a LinkedIn Person of the Year, recently won the award and been flying around social media. So whether you know Paul from LinkedIn, social media, or hopefully because he does such a good job in the lending industry with the banks, the regionals, building societies across the country, welcome, Paul. We're really looking forward to having you and listening to some insight on what you've seen in 2020, what you think we're going to see in 2021, and a bit of the fun activities you've been doing online and through your socials. So welcome, Paul. Really happy to have you.
Hi, everyone. Thanks for having me on, Rob. Greatly appreciated.
As usual, all of your questions on the right-hand side, you write in the question, we will give you the answer. Normally, we'll involve your questions within the answers we give, but if there's anything that's a curveball or anything you want to specifically ask Paul, feel free, type in the question, we will give you the answer. As always, we go straight into the data and give you the weekly update. So on the right-hand side, your handout, week 37 post-lockdown 1. Obviously, we had 2 post-lockdowns. This is the data from when we went into lockdown on the 23rd of March. We commenced in 2020, long time ago now. Where are we? What has the year produced? And in week 40, I think we're in week 48 or 49 of our data, week 48 of our data, what has happened and where are the trends? So week 48, you will see at the very bottom, aligning to week commencing 30th of November. We start as always with our new instructions, and that trend has continued. It's in the mid to low 300s. That's a low trend for the year. It's the lowest amount of properties coming on stream. 1, because of lockdown 2, 2, because of the seasonal part of the year now. We're literally in the last 2 weeks of trading before Christmas. That means very few properties are coming onto the market. That's the trend we've seen for 3 weeks, a long way away from the September highs of 600-700. And now we will have to see when we return the second week of January what the new instructions are looking like. Is that going to be an upturn? is the market going to carry on with a buoyancy? Watch this space. And when we return in the new year, we will give you all of that data. And then the latest figures in terms of sales, 226. Remember, last week was a record high, 235. Strong sales. And we're going to just see that as the year ends out until the conveyancers and the lenders and the banks carry on working until the last moment on Christmas Eve. Those sales are going to carry through, and then we will see in the new year what those sales look like. But huge demand, huge volume, huge numbers, record approvals, more or less 13 years, as we discussed last week, nearly hit the 100,000. As we said, our data back in October, we said we expected mortgage approvals for purchases to hit 100,000. Our data, which is live and not 2-3 months behind like Bank of England or Land Registry, because it's live, we can make those predictions in terms of what we're seeing happening on a daily basis. We expected 100,000, it ended up being 97,500. Very strong figures. Anything you want to add on that, James? And also we're asked for Paul's view on that as well.
Yeah, no, thanks, Rob. It's good to see the year ending strongly with those sales figures, 226, which is one of what continues to be one of the best performing months. I think this is on the back of that sort of really hot market and pent-up demand, which we saw in the September, October times with those agreed sales now coming to fruition and transacting. So that's very positive. Again, as expected, we've seen instruction levels dip around the sort of 300 mark. This is expected and isn't a shock to us at all. Those that are gearing up to market their property will often wait for that sort of seasonal bounce, if you like, in January. So we will wait to see what happens then, but we would expect an influx of new instructions to happen then. And I'd be interested to get Paul's quick view on this. I imagine they sort of are at the forefront of this as properties are agreed. They're sort of on site, dealing with clients sort of and their needs, and involved right at the very beginning, getting the sort of AIPs in order, and then going through the sort of valuation process and on to the transaction.
Yeah, I would totally agree, James. I think that the figures that I see on a daily basis at Mansfield would back that up. Pipeline is at a point that it's never been at previously, which you'd imagine. We've touched on the second lockdown already. So yes, that had put a few things back, not a huge amount. And I think, to be fair, I think we're going to finish very, very strongly. And I think I would echo that for the rest of the market. I know that we will, and I know that a lot of lenders in our space are going to find exactly the same thing as well. So I don't think it's going to be an easy put your feet up Christmas.
Yeah, I just had a quick point there. I noticed that Buckinghamshire Building Society suspended their new applications this week just because of the unprecedented demand. I don't know if that's anything you've ever known in the industry or have had to do yourselves.
Well, I think Notts had done the same thing as well. Notts Building Society a little while back. Again, it's that demand piece, and I think that any lender that's going to come out of this well during this period is going to come out of it well because of the service angle, how well they've been able to turn things around. I've seen a lot of lenders that are putting a lot of emphasis into service, and I think that's definitely the way forward. I can see why the books have done it. I think they've also gone to quite a high LTV as well. So again, it could well be a case that they've taken it up to that measure where they want to take it to, and then it'll just be a case of now managing expectation. And I think that's the bit from our side as a lender. We want to manage expectation of not just the broker, more importantly the client as well, because we'd rather not overpromise and underdeliver. We'd rather go the other way. So I think that'll be the reason why.
Okay, thanks, Paul.
To close off our data for this week on handout 1, I think it's really fascinating to see the closeout of the November numbers for the super prime 10 million plus. Record numbers in that month for a year and many years, and a message we keep repeating, a risk message for all of you using credit and risk. That market is buoyant. 10% of all the super prime transactions are achieving over market price stroke value or marketing value figures. So let me repeat that. 10% of all the prime, super prime transactions are achieving over marketing figures or market value figures. So in our world, in a risk and credit world, that is called a premium, okay? So when a property achieves above market value or a marketing figure, it is achieving a premium. And we're seeing from our data that more or less that's 10%, representing 10% of those transactions. Now, within those transactions, it's for us to break down whether the premium reflects market value or the premium is what someone is willing to pay over and beyond market value to get that property, bring it down to a credit perspective. That means we need to understand what we're lending against, because if tomorrow we have to resell that property, are we getting what someone is paying for it, or are we getting the figure that reflects the value below the premium? And that's a really cute nuance that I'm reporting here in a prime, super prime space, but it will repeat and happen across the board. So I don't care whether you're buying a property in Mansfield for 200,000 and someone really wants that property and it was marketed at 180,000. It is the valuer and the risk team and the lender's requirement to ensure that they notice that difference and it's reflected in the lend, and everyone is aware that you go into the transaction on that basis. Because just because it's happening in the prime, super prime space, it doesn't mean it doesn't repeat. I can assure each and everyone on the call, it repeats everywhere across the country, across all transaction levels. It's just more highlighted when you get to prime, super prime, because the difference is 1 million instead of the difference being the 20,000. Not that I understand the pricing in Mansfield, and maybe I've gone in too low. But if that's the case, too high, sorry about that. So real key point. Next point I want to make about the prime, super prime data is the stats that have closed out over the last few months is 20% year-on-year growth in house sales and house properties coming on the market. And that really reflects the demands and the shift change from lockdown and the new trend that we're seeing. So the flat market actually is flat year-on-year. It's flat in terms of the volumes where it's reached, but taken into consideration that we're now seeing 13-year highs in approvals and purchases and volume, it's actually down. Because the fact that it's at the same levels, if you're getting so much volume and so many approvals and so much demand, you would expect to see it higher, and it's not higher because the trend is going in the house direction or the flats which have external space rather than the broader market. And then the lettings market, the buy to let, there's a lot of product on the market. The rents are softening. There's a lot of volume there. The renters are being fussier in terms of location, and that market is being affected. On the flip side, the HMO market is really strong, really buoyant, because it's the cheapest product from a rental perspective. It's the best returning product from an investment perspective. It's the riskiest product from a lender's perspective. So unless you're good at it, you probably don't want to be doing it. And for all those reasons, it's performing well. So there's nuances within nuances within nuances. Paul, you can respond and tell us a bit about your products and where you perform well. But James, anything you want to add on that?
Yeah, I just wanted to quickly, just an analytical point on that. I mean, I think 2020 has been, like you say, Rob, an astounding year for the prime and super prime market. Just a quick note on stamp duty for those properties. So over 1.5 million is 12% stamp duty, with a lot of those properties paying a further 3% surcharge, with it being likely they'll own other properties. So 15% stamp duty on a lot of these properties. Is this a short-term trend, and how sustainable is it with those sort of high punitive stamp duty surcharges? Are buyers working in a 5 to 10 year cycle to try and offset those that 15% stamp duty on the purchase price. Just your thoughts on that. There's obviously mooted changes to the stamp duty system and a possible sort of softening of that, maybe lowering some of the charges, but how sustainable, what do we see in 2021?
I mean, from my side, we see what we see in as much of a lender, and what business we're seeing from an inflow point of view. We've touched on areas of performance and areas that are not performing. We've not gone at high LTV for the simple reason being is that we're a niche lender. We go in to try and service the underserved areas. So from that side, we know where we want to aim our marketing, and we know what part of the market we're aiming at. The one thing we've seen a huge uplift in, you've touched on this there already, Rob, is buy to let. So buy to let has absolutely boomed. There's been an awful lot of people that have taken advantage of price hiking. Like we say, a lot of people have added the price of stamp duty onto the asking price of their property and have then put it on the market at that. And we see it a lot. I see it where I live. So you can see it happening. But properties are going and properties are selling. A lot of people are selling now, even potentially moving into rental properties to potentially take advantage of whether it's a price correction that's on its way early part of next year. I think this is the hard bit. This is the hard bit of trying to predict as to what's going to happen with the Help to Buy scheme, the stamp duty scheme. There's an awful lot of things that are in our way and an awful lot of roadblocks that we need a bit of clarity with. So obviously, I know the government have got a lot on the hands at the moment, sorting out with vaccines and whatnot, and keeping us all in lockdown. Well, us in the north in lockdown, I'll add. But yeah, it's going to be an interesting time. But we're seeing an awful lot of interesting trends, and I think one thing to mention on the back of that as well is the area that we're seeing a huge uplift, and a lot of lenders jumped out of this space, was holiday lets. So we've been in it. We sit quite well there within that space, but again, we've had to manage our own budget according to the amount of business that we've got coming in as well. So there's a lot of big building societies that sit in that space, and I know that there's an awful lot of business there as well. So albeit there's been a price hike in certain areas, holiday lets in some of the nicer areas in the country, your Cornwalls, we're seeing the opposite in as much of reductions because people are looking to take advantage and get a quick sale. And if you were looking to book a holiday next year, would you be flying to Mallorca, or would you be looking for a nice seaside stay in Cornwall? So there's definitely demand there, and I think people will be opting for a staycation. But it's going to be really interesting, really interesting. And I think, I mean, I've worked in finance for 15 years, and I don't think we've ever had conundrums like this where we try and predict what it's going to be and which area to work in. But I know the one thing that we do at Mansfield and within our product committee is try and establish and find out what that next niche will be, because again, that's the area that we sit.
Yeah,
I think, sorry, James, I think that's a really interesting point, and we touched on it pre-call, and maybe you'll expand on it in a second. I think what lockdown in 2020 has given us, and especially from the boutique lenders, the smaller lenders and the more niche companies, not just in terms of the banks and the lenders and the building societies and the challengers, but also from a valuation perspective or from a service perspective across the board in the supply and distribution chain that's required within the industry, so property, lending, finance. What you've seen is if you're really good in an area and you provide great service, great turnaround, good product, attention to detail, client care, customer care, you can massively outperform the market because you've got the agility and the flexibility to move fast, where maybe the bigger firms can't move so quickly because their committees or lending don't allow for that. And the same with us and our competitors, because we're quite boutique-y and we are strong in some very good niches where we really perform well, whether it's low-end high street commercial, HMOs, or it's the prime, super prime space. So we have 4 or 5 really good areas where we're very strong, deep and narrow, and we can move quick. Whereas the rest of the market is very slow to move. They're delayed by timing, credit. They can't get the deals through quickly enough, and so I think everything's bottlenecked. And even in the high street and pure retail terms, the independents trading well because they can get a product out there that the market wants. The brands and the retails can't move that quickly. They're really struggling. And that's also reflected in the end user. I want to live in the village that has the independents that give me all of that. And the brands are closed. They're not helping me during lockdown. They're no good to me. So I've said a lot there, Paul, but maybe you can sum that up from a Mansfield perspective and a product perspective of where you performed well.
So again, it's kind of going over what I've just kind of touched upon. You're absolutely right, and it's like trying to turn the Titanic. We're not the Titanic. We're small, we're nimble, we're agile. We don't need a huge amount to fill the buckets that we've got to keep everybody happy. So for that reason, we can go into the markets that we feel are right. As I mentioned previously, we've not gone at high LTV. From a risk perspective, and that's absolutely fine. It's not a case of us not supporting the market. It's just that we've preferred to sit where we do. I think the areas that have performed, like what we've mentioned, buy to let definitely has performed exceptionally well for a whole host of reasons, and like we touched on there, with holiday let being one of them. What we tend to find and how we react is we look at the market, we look at demand. My team, the intermediary sales support team, we take all of the in-calls, the inquiries, the dips, everything that's coming in. So it's very easy for us to see a pattern that's building. We stay close to a lot of the other lenders as well. So we fully understand which areas they're going to be coming in and out of from time to time, and you can see it happening. Like what you've just mentioned this morning already with the books. I'd seen that myself this morning and thought interesting, but you could see how and why it was going to happen. So yeah, because we are of the size that we are, it does enable us to go and do the things that we can, and then come out. But I think it's that other part that you don't want to be blighted as well. So yes, you want a niche, but you don't want to be going too risky with that niche. The one great thing that we do as a lender, because it's manual underwriting, we eyeball the cases, we take a closer look at what's going on in the background. Is there a life event there? Would that then bounce out from high street? But then when you actually uncover the stones and the rubble that's underneath it, everything behind it makes sense. So we sit in a common sense space. Like I say, not too high in LTV, but common sense, and can we do it? So we're always looking for a reason to do it as opposed to a reason to decline it.
I love that piece, Paul, because I'm very romantic around old school lending. I believe that if you understand the person, the Mrs. Smith or the Mr. Jones of this world that you're lending to, and you can make a lending decision on understanding that individual, I think it's one of the best ways you can ever lend. I appreciate it's 2020 and not 1920. So I'm definitely not anti-technology, anti-automated underwriting, but I think when you pull the two together and you take advantage of 2020 lending, and you have the classic romantic approach of pure lending, of sitting in front of the person or zooming the person and understanding what's behind that individual, there is nothing better than classic lending on that basis, because it's your judgment on whether they're going to return the payment or they're good for the money that ultimately decides whether they sit in the good book or the bad book as a lender. And I just think that, you know, I love that. In uncertain, volatile times, it's a key element of lending. And I do feel that in a lot of private banks and even a lot of the big lenders, they have certain departments that are very boutique-y that actually do work that way. So yes, they've got the regulations and the requirements, and a lot of the, ultimately it goes to someone on a desk, and that person uses their wealth of knowledge and experience and understands the trends within the case and makes a lending decision, and away it goes. So let's not undervalue or underestimate the power and the strength of classic lending. In uncertain, volatile times, it's key.
And I think the other thing to add on the back of that, and to probably finish on that piece as well, Rob, is that look at how many regional mutual building societies carried on lending throughout lockdown. Who jumped out, who stayed in? I think the correlation of them figures and there won't be a coincidence as to where that sits.
Brilliant, love that. James, sorry, I interrupted you.
Oh, thank you. I was just going to touch on, Paul, next year I think it's going to be a massive year with obviously Help to Buy being extended. There's the new government initiative that they're working on, the 95% LTVs. The initiative is due to involve some removing of the stress testing for the mortgage applicants, which could be an interesting dynamic on how that differs to the current procedures. So I think that's maybe a sort of a growth area, and certainly one that's government backed and they're really sort of pushing. So any new products you're sort of launching on the back of that at all, or?
I better remain tight-lipped there, James.
Yeah,
I think
sure.
We're looking at anything and everything, and I think that's the beauty of what we have. We've got a product committee every single month where we've got the right people in a room discussing the risk, discussing what's there, discussing what the government are looking to do. And like what we touched on previously, there's never been a bigger opportunity to come up with more niches and look at different ways of lending. There's not going to be a huge amount of people that haven't been impacted by COVID at some point, whether it be a family member or whatever it may be. It's crazy stats when you start looking there. But yeah, we'll always look to support. We've sat quite firmly in shared ownership for a lengthy period of time. We're very au fait with that, quite happy with that, and we'll look to run our, I'm not going to say adverse, but our credit impaired side of things with our versatility range there as well. So I think that other piece, combined with common sense lending, combined with looking at the case under its skin, trying to dig a little bit deeper and actually have humans making the decision, I think it puts us in a very good space to look to try and support with it. And not just us, I would imagine a lot of other regionals will feel that way.
Thanks for that, Paul. Just finally, I was going to add, with obviously there's quite a social migration outside of cities across the UK, and real demand for sort of here in London, people sort of moving out towards the home counties. I noticed that you mentioned possibly sort of growth areas, sort of self builds, maybe something you're looking at as well at all as a growth area. Maybe that sits on where they left.
Self-build will be, and again, obviously the government scheme is there with Help to Build as well. So we work very, very closely with Build Store. So we don't do anything direct. It is all through the experts at Build Store. But again, that's going to prove vital because again, there is only so many properties, and like what you've said, if you were looking to buy a house going forward, you'd want a bigger garden. If you've got kids, you'd certainly want an office. If you haven't got an office, to enable you to carry on working as we have over these last 9 months, 9 months now. So I think self-build will be a really, really popular area, or custom self-build. And as I say, the experts at Build Store are more than happy to help with that. We've seen a surge in demand as the year's gone on. So yeah, huge area, huge.
Thanks, Paul.
Paul, let's go to 2021. What are you thinking? What are you seeing? Where do we see the market heading? Talk us through. Look in your crystal ball and share with us some of your thoughts.
Look deep. I think there's no way of getting away from the fact that there has to be a correction coming. There's no possible way that we can be opening the newspapers, reading what we are about Debenhams, reading what we are about all these retailers where people are losing jobs. And it's horrible and it's miserable to look at it. But unfortunately, it's the truth, and it is what's going to happen. How many other shops are going to close down? How many of them are going to need further assistance? Are we going to have, your local shops? Are we going to have retail areas, or as many of them, because they pop up everywhere? So I genuinely think that there's going to be a correction coming at some point. I think the government doing what they are doing in extending certain pieces are going to help, but is that going to help, or is it just simply going to delay? And I think that's the piece. Yes, the way that it would have sat in March is that we'd have dropped off the cliff at the end of March, which it's good that there's been some kind of movement there, but it's going to be an interesting time. I was looking to buy, so I can tell you what it feels like from a buyer, knowing from what I know as a lender. So I'm not looking to buy at the moment, even though I could make on the property I'm currently in. I would prefer to wait till middle of next year, and I think that would probably be a wiser choice for me personally. So if that tells you what I think, then great.
I see where you're coming there, and I do think that the question hasn't been answered. And at the moment, we're in a classic 1980s computer game, and you're walking in a forest and you get to a junction and you have to decide which way you're going. Are you going right and you're going to put more money into the market? This is the government, and you want it to grow and it's going to drive the economy, or are you going to go left and allow it to fall off a cliff? I believe that the government are going to go down the right path, and they're going to push the can further down the line for it to be a problem for another person or another government or another time period, because I think they're going to see that property is going to be the economic driver, and they need it to be buoyant for it to drip feed into the rest of the economy. That's what I believe they will do. Time will tell. So I am with you on that one. Finally, you've shot to fame over the last few weeks because of your award, LinkedIn, your social media presence, some of the things you've been doing through that that have been very, very fun to watch, and I've laughed like everyone else. Maybe share with everyone a bit what it was like to win the award, and also really property lending on a serious perspective. What does it look like moving forward as a communication tool and social media for 2021?
I think LinkedIn for me, it's been absolutely huge. So I mean, I started back in Mansfield in September of 2018, and the one thing that I'd noticed when I came in, having worked for RBS, was that there hadn't been a huge amount of work done on LinkedIn. But yet it's free advertising, it's free marketing. It enables brokers to see you. And I think the one thing that I've always done with it, I've always just been me. And I think that's the piece. If you try and be something else, then it won't come across the same way. So I've tried to have fun with it. And in all honesty, the reason why I've dressed in bizarre clothing, done dances, getting out of cars, jumped into paddling pools, bleached my hair for charity for the NHS, I've done all sorts of things for other charities like Seed. So Gemma Orton, who's the manager of Seed, formerly of Emmerdale, done a lot of work for them as well. It simply is that I don't want to pick up my phone, open LinkedIn and see people whinging, moaning, being negative, and it isn't me. So I've tried to inject a little bit of humour, a little bit of fun, keep people smiling, and if I'm being honest, it's just gone from there to there to there to there. And it's been good fun. It's been good fun, and I'm a people person. So I'm from the northeast of England, beautiful little town called Middlesbrough, and we're people. So I miss that interaction. I miss getting out and about. I love my time with my family. It's been amazing to have that, but I miss the interaction. So I've used LinkedIn and social media as a way of keeping on engaging with my colleagues within the industry, with the brokers within the industry there as well. But from a selfish point of view, because it's the job I'm paid to do, it's been an amazing vessel for bringing in far more business. I don't have 30, 40, 50,000 pounds to spend on awards dinners. I mean, obviously we wouldn't have been going to them this year, of course, but I don't have that budget. I've got a small budget every year, and I want to support the clubs and the networks that we work closely with, but that only goes so far. So because of that, the use of LinkedIn, the way that we can try and gain additional USPs, and I'd class our personality and our way of going about things as a USP, because people buy into it, people engage, start conversations about nothing. Thanks for that video, enjoyed that, blah blah blah. By the way, I've got a holiday let property. What do you think of this? And they're possibly brokers that have never thought to use this before. They've never heard of Mansfield. They've never been there before. What they don't know is that that's where Sherwood Forest is. So I'll tell you that now. But yeah, it's one of them things, and I think it's that bit that makes us stand out, and it's that personable bit that people want to buy into. And I think when people have looked for a distraction to take them away from turning the news on, looking at what the figures are at the end of the day, they've hopefully got on there and had a little bit of a chuckle at the things that have been going on. There's always a message behind it. Yeah, if they're looking in my direction, it means they're not looking elsewhere. So yeah.
I love that, Paul, and I resonate with it massively and share a lot of your sentiment. And the reason why we have the show is because I was on the phone or on Zoom calls or Teams calls for 7, 8, 9 hours a day with the lenders in March and April, and I couldn't get the message of what was happening in the market and the data and the intel and the risks and the sales, the positives and the negatives across. And it was 7, 8, 9, 10 hours a day on permanent calls. And we've moved into the social media just to share a message. And a lot of the time it's been a positive message and reflecting on the good things happening in the industry. We have 100 lenders, and I would be meeting all of those 100 lenders for meetings and coffees and so on. And I love that part, same as you. I'm no different. I love that. I'm only in the business for that, and that's what I love passionately, is meeting our clients, helping them, hopefully solving some of their problems and helping them do their job better. And when COVID happened, we couldn't do the job the way we were doing it, so we had to slightly do it a different way, hence the platform, hence where we are today, hence you being on the show. James, what else you got before we close out?
Thanks, Rob. Just in terms of property news, wanted to bring you an update from October when we mentioned about Lone Star approaching McCarthy and Stone for a takeover, which in October I think was around the £640 million mark. This is now increased to 120 pence per share, valuing McCarthy and Stone at £647 million, which is a takeover in the offing there. Obviously, Lone Star being one of the market leaders in build to rent, as we are currently. And just a bit of a side note on that deal, the McCarthy and Stone did their first IPO in 2015, which valued the company at close to £1 billion, with the share price being over 200 pence. And it's just interesting that takeover and how it develops. How will that allow Lone Star to build in terms of their market share in the build to rent market and industry?
Great, James. Before I give Paul the final word for today and thank him once again for coming on, I just want to show gratitude, appreciation to all the lenders, all the credit teams, all the risk people, all the sales people, for all of their input across all the platforms, for being on the shows and having the thousands and thousands of registrations we have. This is only here for you. We're only here to give you intel, data, how we see the market, what's happening on the ground, and give you live feedback and updates. You are the entire show, and we're only here to serve and give you that. Paul, last message from you before we leave for this year.
If you're not linked in with me, get linked in quick, because it's interesting and it'll keep you entertained. And use Mansfield. Use a small regional mutual building society that wants to help you and your clients. And apart from that, thanks, James. Thanks, Rob.
Brilliant. Thank you so much. Thank you, everyone, for joining. Keep following on all of the platforms. Keep asking the questions. Keep asking for information. We will give you all of the intel, all of the data, and we will see you all in 2021, where we'll carry on the shows. #AskRobCo. Have a great Christmas, New Year. Be safe, be healthy, and speak soon. Thanks, James.
Thanks, everyone.